Hello everyone, welcome to today's US Open live webinar. It is Tuesday, February 28th, the final day of this month, 14:20 GMT, 10 minutes before Wall Street opens. This is your host Nikos Zabouras, Senior Market Specialist. And this week we have the EU-UK trade agreement in the spotlight. Other than that, not a super exciting week. We're mostly digesting data we saw at the end of the previous week, such as the hotter than expected PCE inflation from the United States. And there are also a few other things that we will be talking about today. Before we move on, however, as always, please read carefully through the disclaimers and the risk warnings. Okay, let's go ahead and get started. As we are looking at USD, let's go over, as we said, a few things that are in focus over these days. The USPC inflation accelerated in January, as the data from Friday showed, and this actually reinforces this higher for longer narrative by the Fed, and markets have adjusted to that. On the other hand, we got yesterday some fresh comments from the nominated for successor of Governor Kuroda at the helm of the Bank of Japan. It didn't upset the status quo, despite another surge in inflation in Japan. We also said that a trade agreement over Northern Ireland between Europe and the European Union and the United Kingdom was agreed. It was agreed yesterday. That helps sentiment, may remove a source of friction in the relations between the two, the UK and the EU. And we also got another round of Sino-Western tensions since our last session on Thursday, as the European Commission banned employees from using Chinese social media app TikTok, which has come under fire in the US as well. And the reason is that they aim to protect themselves against cyber security threats. Meanwhile, a little bit earlier, we got over in the US, we got the quarterly results from US retail giant Target. Comparable sales grew 0.7% year over year, but guidance was conservative, speaking of a low single digit decline to a low single digit increase in the quarter that is currently underway. Fourth quarter operating income margin rate was 3.7%, a big slump compared to a year ago, but Target expects it to strengthen to 4 to 5% in the current quarter. So overall, we would say mixed results. There, some of it was encouraging, some of it was not bad, and the guidance is also a bit conservative, we would say. While Target CEO said that they are pleased with comparable sales growth, and also talked a very challenging environment. So having said that, let's move over to Euro USD. which is said to conclude its first losing month since September, harmed of course by the repricing in expectations around the Fed. Recent inflation data have reinforced, as we said, these expectations for a higher terminal rate, and markets have also begun to phase out prospects of rate cuts. The latest inflation report, of course, came on Friday. Core PCE grew 7.7% year over year, where headline 5%, both marking an acceleration, compared to the previous month. However, the pair has made a strong start to the week, helped by the EU-UK trade agreement, and just we will elaborate a little bit around this in a bit when we talk about GBP USD. In any case, as we said, Euro USD made a strong start to this week, helped by that, perhaps also by month-end flows, since, as we said, this is a losing month. Maybe month-end flows cover some of that, and also some regional CPIs from Europe. In any case, if we take a look at the daily chart, we can see that the common currency defended the 200 days exponential moving average, and going back to the 4-hour chart now, we can see that it tries to retake the 200 period EMA on this chart. We can see some further strength here, but we are a bit cautious. It would need a catalyst for further advance towards and beyond 1.08. Now, despite this renewed vigor, let's say, it is still in risk of a deeper correction towards the 38.2% Fibonacci here that we have highlighted before, but the downside in general seems well protected still, and a strong catalyst would be needed for sustained weakness, and not much has changed since our last outlook of Euro USD. Now let's move over to GBP USD. Similar situation here, also running a strong week. Some of it is probably due to the optimism around the deal between the European Commission and the UK government. So what we had here is that after Brexit, Northern Ireland, under the Northern Ireland Protocol, essentially remained within the EU's single market, and products coming in from the UK were subject to checks and controls, which of course Northern Ireland is a part of the UK, so there was a problem there, and this had caused friction between EU and UK, and it was a source of tensions. Now we have an agreement between the decides to replace this Northern Ireland Protocol. UK Prime Minister Rishi Sunak has said that he will put it to a vote, while opposition leader Keir Starmer has said that the Labour Party will back it, but even if it passes, it will still be interesting to see how Tories react to it, and if all of them will support. Actually, all of them probably won't support it, but mostly if we will see any resignation, or if it will fly well with the Tory party. Now, in any case, on the technical front, we're seeing testing the 200 period EMA, given this boost it gets since yesterday. We can see a push through the upper band of the daily Ichimoku cloud here, but it does not setting new year highs at 1.2449 here seems like a tall order given the monetary policy differential between the Bank of England and the Fed. It is in a perilous position, we believe, GBP/USD, and to us, fresh 2023 lows, not high, seem more plausible at 1.18400, although a catalyst would probably still be needed for that. And let's take a look at USD JPY, again on a 4-hour chart. So it's been on a roll this month, gains around 5%, again on the back of this Fed rate repricing, and we also got the hot inflation report from US on Friday. We also got a strong inflation report from Japan on Friday as well, as CPI ex-fresh food rose further to 4.2% year over year in January, and the highest since 1981. But markets look past it since they focused more on the comments made by Mr. Ueda, who is nominated to succeed Governor Kuroda at the helm of the Bank of Japan in April. He essentially maintained the status quo, said that current policy, ultra loose policy with yield curve control and negative rates is appropriate, but also sort of warned that if trends in inflation change, perhaps they should adjust. So all in all, given with what we have heard so far from Mr. Ueda, it doesn't seem like he's gonna do anything surprising, but of course anything is possible. In any case, we believe that the door to policy normalization has opened, but it's gonna be probably a long road and slow road to that. As such, the pair tackles 38.2% Fibonacci of the October multi-decade high January low drop, as we expected, and this brings 50%, the 50% level in the spotlight, although the move does seem a little bit overextended, and it may be premature to talk about this taking out of this level. Now, as we said, the move does look a bit overextended, and pressure back into the daily Ichimoku cloud would not be unreasonable, a little below 135, although a test of the 200 period EMA does not look easy under current conditions. And as we're already a few minutes into the US session, let's shift gears and check out NASDAQ, the tech-heavy index, which slammed last week after the USPC hot USPC inflation report, which supports this higher for longer narrative, which sinks in, and it's heading towards a mixed month after a strong start to the year. Now it's a little bit difficult. It's a difficult setting here from a technical perspective because of this this shifting expectations. It closed last week below the 38% Fibonacci of the last leg up, and this keeps it in a tough spot. Let's say it is still very vulnerable to further decline towards 11,500, 11,400 region, but we're cautious for further weakness that would challenge the 11K mark. On the other hand, the tech-heavy index finds some support and shows resilience to these renewed expectations around the Fed. So we can see more upbeat mood, but does not inspire confidence for fresh 2023 highs at 12,900. And let's head towards the end with what's ahead until our next session on Thursday. We expect tomorrow Australia Q4 GDP. That's on Wednesday. Q3 was 0.6% quarter over quarter and 5.9% year over year. The Australian Central Bank expects little below 3% growth over 2022 and forecasts slower growth this year. Also on Wednesday and Friday, we expect a series of PMIs from various regions, including the United States. And on Thursday, before our session, we expect February preliminary inflation from Euro area, CPI inflation. Last week, we talked about the final figures for January, which were higher than the preliminary ones. So definitely a sticky situation there as well. Now on the earnings front, EV startups Rivian from the United States and NIO from China will be in the spotlight. That's it from today's US Open. We'll talk again on Thursday, same time, 14:20 GMT, 10 minutes before Wall Street opens. Thank you for joining me.